The current market operates in two distinct states. On the surface, violent price shocks are flushing out retail traders. But beneath that chaos, the structural foundation remains completely static. This dashboard tracks the macro timeline. Under the all-time high data, we see the severity of the recent move, a 48.4% decline from the peak, with the spot price currently hovering near $65,050. Despite that price action, the network itself is functioning without interruption. We can verify this at block height 954,110, where the chain is actively processing new blocks. A drawdown of nearly 50 ignores the specific mechanical forces that are currently pinning the market in place. To find those forces, we have to look past spot selling and check the derivatives market. Specifically, we need to locate the massive volume of capital currently trapped in over-leveraged contracts. This heat map illustrates that trapped volume. These dense blocks of liquidity, the bright yellow and green bands, are sitting immediately above the $65,000 line and just below $66,000. The scale on the far left proves the risk density. There is over $32 million of concentrated leverage stacked within this single trading range. This concentration of capital creates a localized gravitational pull. For institutional market makers, these bands function as an algorithmic magnet for future price action. This current environment is driven by predatory execution. We aren't seeing a fundamental panic. We're seeing algorithms systematically hunting over-leveraged retail positions. High-frequency trading engines probe market depth. They sweep the order book to locate vulnerable leverage clusters, then orchestrate moves to consume them. A forensic review of the trading patterns from June 11th through the 13th reveals this hunting cycle in real time. This chart captures the setup. The deep purple background shows an absence of broad retail activity, isolating a single bright yellow band of concentrated risk forming at $61,000. With the target isolated, the execution phase begins. The algorithm drives the spot price downward, wicking precisely into that lower liquidity band to trigger a cascade of automated stop losses. Once that liquidity is harvested and the market maker fills their inventory, the selling pressure disappears. The price immediately snaps back above $63,000. These intra-week swings are the engineered output of execution algorithms. They reflect derivative settlement rather than organic shifts in the asset's macro value. Once the lower bounds are cleared, the algorithms immediately recalibrate. They shift their targeting upward towards psychological resistance levels. This heat map shows the subsequent upward strike. We see a sharp, vertical price recovery, driving straight into the upper liquidity bands near the 65,500 range. This rapid ascent is designed to catch short sellers off guard. It clears the order book of competing institutional shorts, providing exit liquidity the market makers need. Notice what happens after the upper band is neutralized. The aggressive volatility stops, and the price begins flatlining, bouncing off the $65,000 support line. The market enters a stabilization phase. Algorithms are now waiting for new leverage to accumulate before initiating the next strike. The spot price over the last 6 days is merely a footprint of high-frequency execution. It has become entirely decoupled from the actual fundamental security of the network. To see the true state of this asset, we have to move away from the high-frequency derivatives market. We need to look at the physical, thermodynamic reality of the base layer. Maintaining this infrastructure requires massive industrial-scale capital. These facilities represent a global commitment to physical hardware and long-term energy contracts. Traditional economics suggests that a 50% price drop should force these producers to halt operations. In a typical commodity market, that drop would make extraction unprofitable. But the network's security data shows no signs of an operational retreat. The hash rate is holding steady at 887.9 exahashes per second. Even with price volatility, network difficulty remains at 124.9 trillion, indicating competition is as fierce as ever. Large-scale operators survive this margin compression through hardware efficiency. By deploying newer, efficient ASICs, they maintain output even as the price declines. While individual miners may be selling off their treasuries to stay afloat, the hardware itself stays online. Massive corporate entities are absorbing the financial pain while keeping their machines plugged in. The network's operational capacity is actually expanding alongside this drawdown. The hash rate is a physical commitment to the protocol, and right now that commitment is at one of the highest points in history. While traders are focused on the price, enormous blocks of institutional capital are moving across the base layer with absolute mechanical precision. This is possible because of a critical anomaly in the data. There is virtually no block space demand from retail users right now. The mempool acts as a waiting room for transactions. Currently, only 3,033 transactions are waiting globally. With this empty queue, the cost of moving capital hits an absolute floor. The minimum fee rate is exactly 1 Satoshi per virtual byte. This creates an asymmetric advantage for the largest players. They can execute massive structural reallocations and move billions of dollars on-chain for the price of a few pennies. Retail capital is currently distracted by high-frequency derivatives noise. While they worry about the next candle, smart money is using this quiet period to fortify its on-chain architecture for the next cycle. The data reveals a market in two halves. On top, we see predatory hunting in the liquidity bands. Below, we see a thermodynamic foundation that is stronger than ever. For quantitative traders, the framework for the next 7 days is clear. You have to ignore the macro noise and trade the divergence between network security and price volatility. Institutional players will use the low-fee base layer environment to fund next strikes on these remaining liquidity bands. Spot market volatility currently reflects the cost of derivative settlement, not a decay in the asset's value. Success in this cycle depends on ignoring the noise and trading the leverage bands, backed by the security of the base layer.